This is the Money Seed Podcast, where we discuss all things investing, plain and simple, the way it should be. Please remember, this show is for educational and entertainment purposes only and is not intended to be investment advice. Welcome back to the Money Seed Podcast. I'm thrilled to have Bronson Hill from Bronson Equity with us today. Bronson is a real estate investor. He has moved on from single families to multifamilies. He now runs Bronson Equity, where they specialize in syndication deals in multifamily space. He also dabbles in the ATM business, and we'll talk a little bit more about both of those. Bronson, welcome to the show.
Hey, Gabe, really excited to be here. I love talking about finance, particularly non-traditional finance. So I know there's some things that I do with a little non-traditional, and I look forward to jumping in.
Yeah, thanks very much. Why don't we start right there? So one of the things that attracted me to you right off the get-go is one of the points that you mentioned in your email when we started conversing was that you think saving money is foolish. And as soon as I saw that quote, I said, okay, I know this is going to be a great interview because anybody who has non-conventional investment advice, I think usually has all kinds of nuggets and some very interesting life experiences. You know, a lot of people just say, work hard, put your money in 401ks, and you got nothing to worry about, you'll be fine. And yet we all know that most Americans will not be fine by just putting their money in 401ks. And so every time someone says, look, I got a non-conventional investment story for you, I'm here to listen. And so tell us more. Why is saving money foolish?
Yeah, well, I appreciate you having me today. It really comes down to what we're seeing in inflation. I mean, it used to be, I remember being 8 years old and my grandmother took me to, this is in Seattle where I grew up. She took me to a bank and said, we're going to open up a bank account where you can put your $2 a week allowance in. And that was really seen as a virtue, particularly of her generation. If she were alive today, she'd be around 100. And, that was just a thing. You saved, and that's it was a virtue. These days, when inflation is high, they're saying officially 7.1% at the time of this recording. I think it's more like 15% if you look at a site like Shadow Stats, which includes just, actually what costs are and not substituting items in like they do on the consumer price index. But if that's the case, then if I leave money in the bank, if I literally have money in the bank and I have $100,000 in there, I could be losing $7,000 to $15,000 a year just by keeping it in the bank. So there's a quote, a couple different people said this. Robert Kiyosaki, who wrote the book Rich Dad, Poor Dad, he said, cash is trash and savers are losers. So it doesn't mean like they're not good people. It just means they're losing money, right? And Ray Dalio, who runs the largest hedge fund in the world, he also says the same thing. He says, saving is losing. And so I think, these days when inflation is high, I think it's important to look at not just saving, but how are you actually investing? How are you putting money to work so that you're buying things where there's an inflation hedge, right? If I just simply hold cash, I'm being punished by inflation. If I'm on a fixed income, I'm being punished by inflation. I see it every time I fill up my car at the pump, every time I go get groceries at the store, and I'm only seeing the painful side of that. But if I own assets, particularly using debt, I can actually, in a way, use it to my advantage. So I think, the common thing, a lot of gurus are like, pay for cash with everything, and debt is bad. And I kind of do things a little different, where I'm like, there is such thing as good debt. There is such thing as trying to have as little. You have some savings, some money, at hand, or some dry powder in case, just for a rainy day. But I think in general, I'm about 95% deployed of my whole net worth in different deals because I don't want to hold cash.
Yeah, well said. And I agree with you. I think inflation, even though the official figures, I think now the official figures are around 7%. I mean, right now, for the record, I think we're in mid-December 2022. Earlier this year, the official figures were 10. Now they're around 7-ish. But in reality, I'm with you. I think it's much higher. I also think people need to be aware that we're calculating inflation slightly differently than we were back in the 70s. So when people say, oh, inflation was 11% in 1970, it's 11%, whatever, in January 2022, it's like, well, it's not the same 11%. The biggest contributors, I think, are housing and food, and we calculate those differently than we did back then. Not to segue, but just to add a little bit more weight to your comment that, I think real inflation is actually higher than what they're telling us.
Yeah, they call it the CPI, the Consumer Price Index. It's also known as the CPI. Because what they do is they have multiple things they do where they come in and the incentive, what's the incentive of the government to have that be as low as possible? Well, it makes government officials, because I have inflation under control. What they'll do is they'll do things like this, Gabe. They'll say, well, you love eating apples, right? So you love apples, but suddenly the price of apples doubles. What they say is you would make a switch to oranges, which are the price of what apples used to be, just simply because, and then that doesn't actually change inflation at all. Even though the cost has doubled, they'll just substitute something else in there. Another thing they'll do is they'll say, if you live in a 2-bedroom apartment and it's $1,000 and it goes up to $1,200, well, they say, well, you would make a switch down to a 1-bedroom, which is still $1,000. So these are things that people don't really do, right? They don't really actually make those changes. But from an academic and a point of view that since 1980 they changed the CPI index once. They changed it again in 1990. So I just think that it's something that the more we're unaware of what's really happening, we're just seeing wealth just like vanish and fly away. It's not like it's disappearing from our accounts, but the purchasing power is eroding. And we're going to see that, I think, only continue in the future.
Yeah, unfortunately, I think you're right. So Bronson, at some point in the past, you started investing in real estate, and I believe you started out in the single family space. How did you get started in real estate, and how did that work out? And how did you move on from single to multifamily?
Well, I always knew I wanted to be a real estate investor. I kind of took a sideways course to get there. I was a youth pastor for a number of years, did that, loved working with students, and I bought a house. I was in Montana, of all places, bought a house, and then stayed there a couple of years, and the job kind of wrapped up. And so I ended up keeping the house, became an accidental landlord, had it for over 10 years, and realized this actually worked out as an okay investment. I mean, there was some cash flow, it wasn't a lot, but it was a little bit. And so I started buying more single family houses. And that was basically with a relative in the Cleveland area. And my goal was to get to 30 houses and to retire with this passive cash flow. But what I realized is that, on paper, everything looked great. But when it came down to actually how they performed, I wasn't actually getting the type of cash flow that I wanted. And I think that a lot of people starting out in real estate, everybody thinks about single family because it's a familiar asset class, right? Like I live in a house. People are familiar. Most people at some point, especially if they own houses, they've lived in a house. And so it's what we know. But what I didn't realize is that a lot of people really become financially free when they find a way to buy bigger multifamily properties. And at first it can feel impossible, but instead of saying, I can't do that, it's asking the question, how can I do that? Right.
And I think you're right. I mean, that's how I got started in single family, and I'm still a single family investor. I haven't moved up to multifamily just yet, but I think it's the same reason for me, right? I feel comfortable with it. I think I have a certain knowledge of houses, a certain comfort level with houses. I know what the surprises are and how much it costs to change a roof and that kind of thing. And so there's a certain element of whether it's risk management or risk tolerance, but I think I know what I'm getting into risk-wise when I go into single family. And so how many, you said you had a goal of getting 30 single families. How many single families you got up to before you said, you know what, this is like the time and the effort, whatever, I'm just going to move on to something bigger?
Well, I had 4. And, again, I think what I realized is even though I had a property manager for the different properties, and both in Montana as well as Ohio, it was still a lot of work. I was getting a lot of calls. These were not like, 10 out of 10 neighborhoods or 10 out of 10 houses. These were like 4 out of 10, these were like, or maybe even 3 out of 10. So I was getting a lot of, rough tenants and just challenging issues, non-payment issues. And so I had this fortuitous conversation with a relative that I hadn't seen in years, saw at a family event. And this, person, I knew they were real estate. So I shared my plan to get 30 houses and retire from my great corporate job. And I had a very good job. I was making over $200,000 a year in medical device sales. And so my plan was to maybe not replace that, but replace my living expenses, which is about $60K a year. I live pretty simply. If I could just do that, then I could potentially leave my job and just focus on creative pursuits. And so he said to me, this sounds like a lot of work doing the single family thing. Why don't you do multifamily? And I said, well, I'd love to, but I don't have the money. And he said, well, you can raise the money. And he taught me about this thing called syndication, which is a fancy way of saying you raise money from investors, you pool it together, and you buy a big apartment building. And so I just learned as much as I could, took me down a path, ended up starting a meetup in Los Angeles where I live. Met my first investor there. We raised a little bit of money. And then through a series of events, I found a partner, and we raised over the next 18 months after that, I raised about 15 million. So it was just something that, the more I learned, the more I got in the space, the more doors opened, and I just kind of went through the next door. And here it is, 4 years later, and I've quit my job, and I've just pinched myself. I get to do this full time,
That's incredible. I mean, because I think that for a lot of people is the biggest hurdle is how do you actually convince individuals to invest with you, right? Because on the one hand, you have to convince them that you have expertise and you have the knowledge and you can do it and you're trustworthy and they can give, because generally people want to make sure that they trust and they know the people they give their money to, right? And it's not a trivial sum of money. And so what are some of the tips and tricks that you can share with us on how did you make your first sale? How did you get your first deal together?
Yeah, so it was interesting. When I first started out, I had calls with friends and family, everybody I thought would be interested. I remember I had 62 calls or in-person meetings with friends and family. And I went through a survey of different questions of things of, qualifying them. If, certain deals, we have to actually get financial information before you can share a deal with someone. And so I went through all that. And of that first deal, absolutely, zero of those actually invested. So the only person, none of the people that I knew invested with me in my first deal. The first investor was a guy that, I met. There were 60 people at this meetup, the first meeting we had. And he just came up and said, "Hey, I do a deal with you, whatever," because he saw that I was leading in the front of the room and I wasn't an expert in the space, but I was a leader in the space. So I always tell people when they're getting started is try to find a place where you can be adding value. So you're doing it with your podcast. I have a podcast as well called the Mailbox Money Show. We talk about passive investing. We do a monthly panel with a bunch of experts. I'm writing a book right now. Any way you can do things to try to really become a leader in the space and you can add value, people start to look to you and say, "Hey, I want to work with that person." So that's one thing. I guess the other thing I'll say is, and I've had 1,300 one-on-one phone calls over the last 4 years with investors. And one thing that comes up, I've realized, is that there are a lot of people out there that have a money problem. And the money problem is not that they don't have money, it's that they have money and they don't know what to do with it, right? So when you have a deal, it's important to realize that you have something to offer people, right? It's not a scarcity mindset of, "Hey, I'm groveling, trying to get this person to invest in my deal. Would you please consider?" It's really about them and saying like, "Hey, I like this deal a lot. And I really think this might help you." And you have to believe, you got to believe that, hey, this deal that I'm doing is something that really is going to help this person. So when you approach it, not from a scarcity mindset or kind of I don't know, whatever, you just think, no, I've got great partners. I mean, I've been doing this 4 years, but one of my partners who's partners on 5 or 6 of the recent deals has 28 years of experience and 13,000 units, right? So if you find an experienced partner on the operating side, you can really approach with confidence, say, "Hey, this is something we've done before. This is what it is. This is what it looks like." And it is a little hurdle just in your mind to be like, "Yeah, I'm taking somebody else's money." But, it's Robert Kiyosaki, same guy we talked about earlier, he would say it's selfish to just do your own deals with your own money, right? You're not allowing other people a chance to get into a deal and be able to benefit from that as well.
That's actually a really good perspective. Yeah. I like it. Bronson, I know there are 2 ebooks that you recently published that are available on your website. Let's talk about the first one, How to Use Inflation to Your Advantage. Tell us a little bit more about what kind of information is in there and what kind of takeaways a reader would get.
Yeah. So this is, it's for free. You can download my website, 52 color pages, How to Use Inflation to Your Advantage. And basically what I mentioned before is, the old virtue of saving is really gone. It's how can I deploy money so that it's in an inflation hedged assets. Multifamily investing, multifamily apartments, rents generally rise with inflation. If I had there's a chart from Mother Jones, a publication that shows from 1960 to 2020 that rents and inflation move hand in hand. There's almost a straight line. They're parallel lines. Now it lags slightly. The rents slightly lag inflation, but it's a really great correlated way to hedge inflation. The second benefit of it, not only do you know that these rents will go up, but that's what the value of apartment buildings is based on. If I buy single family houses like you were talking about, the value of the house is based on what the other value of houses that have sold recently in that area. And multifamily, it's all based on income. So if rents are rising, it increases the value of those properties. So we know that these will be worth more in the future because of inflation. Secondly, because we use debt to buy these, we typically put 20 to 30 or 35% down. We get to use other people's money, including the bank, to basically go buy this, and then we pay it off in the future when both the asset is worth more and the dollars we're using to pay it off with are worth less, right? So we get kind of a double advantage there, right? We're paying off an asset that we know is going to be worth more in the future because of inflation, and we know that these dollars are going to be less valuable. So anyway, there's some real advantages of it. That's kind of the basic premise of it. You can do it with different asset classes. There's some other alternative assets I mentioned there, like precious metals and crypto and other things. But in general, owning real assets, I'm a huge fan, especially assets that have an inflation hedge. You can use debt to buy and they pay you to hold them.
And I think that's a really good explanation of how you're using inflation two ways to help you, right? On the one hand, inflation is inflating your revenues into the future. And on the other hand, inflation is decreasing your debt over time. So it's helping you two ways.
Yeah, absolutely. Yeah. And a lot of people don't think in terms of debt being a good thing. I think a lot of these gurus and I think, really when it comes to Dave Ramsey and some of the stuff, it really is 101. Like if you spend more than you make, that's a bad thing, right? Like that's not a good thing. So getting credit card debt, if you want a great return on your money, just pay your credit card debt down. That's right. But that stuff is really 101. And so really the first thing is to learn how to live within your means and then be able to deploy capital. So saving can be good if you can save up $50,000 and put it in a deal, or you can buy a single family or invest in a multifamily syndication. That's a great way to use. So sometimes you do have to save, but as soon as you can deploy it, that's obviously better.
Absolutely. Yeah. And getting back to, the Dave Ramsey, I mean, I'm a fan of Dave Ramsey. I think his message is good, but I believe that his message is aimed at individuals who probably shouldn't be looking at investing in multifamily, right? If you're struggling with credit card debt, you're struggling with personal debt, student loans, you haven't gotten your first, home yet, et cetera, then maybe at this point, take care of your personal finances first, then live within your means, then build up some capital, and then look to invest in it.
Absolutely. Yeah. It's really, and the challenge with like Dave Ramsey is if you get somebody who is a high net worth or high earner and they pay off their house and they do all these things, sometimes I think if you have a house and you've got a 3% interest rate on it, I think it's better not to pay the house down. You'll say, well, that's crazy. Why wouldn't you just pay your house down? Well, because you're basically ensuring you're tying up your money when you have debt is so cheap. It's way cheaper than kind of the going rate. I would say, stretch that out as long as you can, make the minimum payment on that, and realize that the asset is it's not the house anymore. It's really the debt on the house. And so again, these are some things that, in general, they're not common wisdom or they're not super conventional, but if you really think about how money works, it makes a lot of sense.
Absolutely. Yeah, I fully agree. Bronson, your second PDF on your website, I believe it's called The Single Best Investment Strategy During and After a Pandemic. Tell us more about that one.
Yeah, so that was actually the first one I wrote. And that one basically talks about multifamily investing. It talks about just kind of understanding some of the tax benefits. There's a way to potentially reduce taxes, defer taxes, or even potentially reduce to zero or eliminate taxes. There's, you have, less volatility in the stock market. So it really compares multifamily to the stock market and other assets. And so it just gives a really good, basic understanding of how multifamily investing works.
And Bronson, to somebody who is not familiar with the tax laws around real estate investing or multifamily in particular, what are some of the strategies that you use to lower taxes?
Yeah, so I actually, like I mentioned, I was making over $200,000 a year. I was paying around a 25% tax bracket, so I was paying $50,000 a year or whatever in taxes. I used some strategies to basically reduce my taxes to about 1%. You say, well, how could you do that? Well, there are things in the tax code that people call them loopholes, but they really are incentives, right? So there are ways that you can use things like depreciation, which just means like when you own a single family house, you can take the cost of the house and depreciate it just as a percentage over 27 and a half years. So that's kind of how it works in single family. And multifamily, we have this thing called bonus depreciation or accelerated depreciation, where you can bring forward a lot of the depreciation to the first year or the first couple years. So it allows us, it's not uncommon, at least in 2022, to see $100,000 invested produce a tax loss. Again, you haven't made or lost any money on the deal, but you're basically able to show on paper that you lost between $70,000 and $95,000, right? So you can basically use that to offset other investment gains if you sold a rental house or if you had some other investment gain, or you can just hold it until that year that you start getting cash flow from this deal. So it allows you to really defer taxes. And then there's this special thing called a real estate professional. And that's how I qualified as if you spend more than half your time in real estate related activities, then basically you can potentially qualify as the IRS designation of real estate professional. And then I can actually use this depreciation, not just against my investment income over here, I can actually bring it over to my ordinary income over here. Or if your spouse is a real estate professional, that's how somebody who's a doctor or somebody who maybe sold a business can pay almost zero taxes. I actually know a story of a couple of medical professionals in California that had a $5 million sale of their business, and they were able to pay only about $125,000 in taxes or tax equivalent. They should have paid around $2 million to $2.5 million. So how do they do that? Through discovering, these different ways to be able to reduce taxes. So again, it's not how much you make, it's how much you can keep. And the more you can keep and find other ways to reinvest, it really helps you on your way to wealth.
Amazing. Bronson, quick question. When you're looking at a multifamily deal, which part of the country do you typically focus on? Where do you think the better deals are to be found?
Well, I know you and I live in the great state of California, and I don't own anything in California. So we've got $200 million in assets outside of California, pretty much completely in the sunbelt. So we have about 1,500 multifamily units in Jacksonville, Florida. That's probably my favorite market in the country. We also have some in Atlanta and some in Huntsville, Alabama. But I like these southern markets because we're seeing so much population growth. And for example, I live in Pasadena, California. The house I'm in right now is a $1.2 million house today. It's 3-bedroom, 3-bath, pretty small, 1,200 square feet, or so. That same house would be about $300,000 in Jacksonville, right? And the quality of life would probably be even better over there, right? So people can buy much cheaper. We're seeing, but the biggest reason really is just the growth. When you have population growth, you have job growth, you have income growth, it just puts this incredible upward pressure on rents. So we've watched rents go up 20% per year consistently. And even in other parts of Florida, such as Tampa or Orlando, where rents are kind of stabilizing out, we're still seeing rents rise in Jacksonville because, like I mentioned, it's a little cheaper to live there. So there's more upside to go. And there's a lot of redevelopment happening there too. So I like buying in areas where I see, population growing and there's a lot of jobs coming too.
And Bronson, what is a typical deal size, and how much are you looking for when you're looking for an investor? What's the minimum that somebody needs to invest with you?
Yeah, so typically when we do our investment deals, with multifamily deals, typically the investment is $75,000. There are groups out there where it's $50,000 or it's $100,000, or if somebody doesn't have that kind of money, they want to get started. There are crowdfunding sites that allow for it. I'm not a huge fan of crowdfunding sites because there are some extra fees. So they have the operator, and then they've got this whole kind of extra layer of fees in there as well. But there are different ways to get involved. I'm a big fan of working kind of directly with private operators that have a good experience and are doing well. So 75K is usually the minimum.
And do you get involved with Airbnbs at all? Like, are any of your units rented out as Airbnbs?
We've talked about it. There's been some we've talked about taking a building or maybe 8 units and converting them to Airbnbs. It's a little challenging because if you have, let's say you have 8 units, I'm thinking of one property that's 120 units. And if you have a building that's got 8 units in it and they're all studios, basically, let's say half of them are filled with tenants. Well, then you got to move those tenants, and that's inconvenient for them. And then you got to renovate it a certain way and put the furniture in, and then you're dealing with the property management a certain way. So you certainly can do it. Where we've really seen a lot of gain is just coming in. Rents, for example, we have a deal we're working on right now. Rents are $1,000. We come in, we spend $6,000 renovating a 1 or 2 bedroom place. We know rents are on average then above $1,500. So basically that's a over 50% upside on the rent. So we know we can dramatically increase the value if we just come in and do those renovations. I think if we were, I think when you have like 1,500 units in one area, getting a building with 8 units or, here and there, whatever, it's a little less impactful for the entire portfolio. I think it could really work. It's just then you're kind of dealing with long and short-term tenants, which brings up some unique issues. But I think there is opportunity there, especially if you're going for smaller multifamily or in a certain type of property. I think it could make a lot of sense.
And how long do you typically stay in a property?
Yeah, so typically we plan to hold a property for 5 or 6 years, but there are times where we sell early. Right? We had a property in Jacksonville we bought March of 21, so March of 2021, and we plan to hold it 6 years and hopefully about double the investor equity. Well, we bought it for $27 million. This is a 288 unit property. We ended up selling it 10 months later for $37 million. Right, so we only put maybe 7 or 10 million down on the property. And then we had a $10 million rise in the equity. So the investors received something like an 80% IRR return. So they got a huge return on their money. and then we're able to 1031 a lot of those investors into another deal. So having multiple exits and having multiple options is really helpful. It could be that you sell in, sooner than you thought. Maybe you refinance in 2 years. Maybe you hold the property longer, or you even things like creative things like you're talking about, like Airbnb to try to increase rents. I mean, there's all these different ideas, and sometimes you don't exactly know what's really going to happen with the particular market or in that particular property. So having an open mind is really valuable.
And Bronson, how was that decision made when you bought it in March of 2021 and you thought, hey, look, property values have really gone up and we add a lot of value to this property. We could get out now and have an amazing return to our investors. How did you approach your investors? And was it a unanimous decision? Did some people say, hey, let's stay in it, let's stick with it for a few more years? How did that come about?
Yeah, so it's interesting when you are a passive investor. That's one of the disadvantages, right? Is that you are basically saying, "Hey, I'm along for the ride. I trust these guys." It generally has to follow the parameters there. We did give investors a choice of, "Hey, this is what we're thinking about, and let's get some feedback." And anybody want? And really, nobody was opposed to selling so quickly. The choice really was, "Hey, do you want to stay in 1031, which is a tax exempt exchange, to go into another deal, or do you want your money back?" And about 95% wanted to stay in and roll into the next deal. And there was 5% that, "Hey, I want my money back. Thanks so much. That was great." The downside of that, of course, is we were less than a year. So there are some kind of shorter term capital gains versus holding more than a year. So, but yeah, in general, we try to definitely get, feedback from investors. Our approach really is to look at investors as, partners. And our goal is really to be long-term partners. So we hope in 5 years, and I think this is helpful for anybody that is either an investor or somebody that wants to do syndication or wants to scale up. It's just the idea of partnership, right? That the people we work with, we hope we have a great experience working with them. They have a great experience with us. And in 5 years, they've said, "Hey, I hope, I've invested in multiple deals. The communication, the performance has been good. I've referred friends and family." And they really sense a real partnership together, right? Because some people look at investors as just, oh, you get the money and then you stop communicating and whatever. And it's kind of a short-term thing. But we look at it like we really want to make sure that our investors feel connected, that they get their questions answered in a timely manner, that we're communicating on bad news, because there's always bad news that happens in every deal. As you know, you run properties, nothing goes ever as expected. It goes better and worse. It goes about as expected, all in the same deal. So how do you communicate that is really important.
Interesting. And Bronson, in this line of work, I'm sure you meet a lot of high net worth individuals. What are some of the takeaways? What are some of the maybe nuggets that you've picked up over the years from very high value investors?
Yeah. So when it comes to high net worth individuals, typically there's a few things that are really important to them. I talked about reducing taxes. That's really important to a lot of people, is trying to reduce taxes. And then also the fact of having these calls is, here's people that, these 1,300 people, the average net worth was 2 million. Some was less and some were substantially higher, over 10 million or 20 million. And so these are people that are really willing to get on the phone and educate themselves, watch webinars, read books. Typically, these are people that really want to grow and want to learn. And so I think that that's something that really struck me. And then another thing is really a lot of high net worth people, a lot of times there's a business. Maybe they own a business, maybe they run a business, maybe they're some sort of a professional, but they're involved pretty heavily in the way a business works. So a lot of these people are trying to figure out, how can I grow my wealth without taking up my time, right? So it's many people are in a time for money trade. So even if I'm a doctor, I knew these doctors a few years ago that I'd worked with, and they each made over $3 million in 1 year. And yet they were working 60 or 80 hours a week. And I just thought, I don't envy them, because if they don't go to work, they don't get paid, right? So they were hustling, they were working. But I think the real issue is, how can you try to make money while you sleep, right? Warren Buffett talks about that. He says, unless you learn how to make money while you sleep, you'll work until you die. And so that's the challenge for a lot of investors that I see, is that if you can't 10x your investing strategy, like if you can't get 10 times the amount of homes or 10 times the amount of investments or whatever it is, and still effectively manage it or be a part of it, then it's not really a passive investing strategy. It's not really mailbox money. It's not that it's wrong. It's just that, we at some point we got to say, well, what can I do and how is this actually scalable? And I think people that are very wealthy or get paid very well, they're always thinking in terms of scale. And they're not thinking in terms of just like, I'm going to buy another rental house, I'm going to do something myself. I'm thinking, no, my time's valuable. How do I maximize this? And, a lot of people find that the returns are as good or better than if you did it yourself and you save yourself the time.
I like that phrase, mailbox money. I'm going to have to remember that one.
Yeah, that's it. And it's funny, I've only probably gotten a couple checks, actual checks from rent and things like that in the mail. A lot of it's direct deposit, but I love the term, and everybody kind of knows what it means, mailbox money. So, and that's, like I mentioned, that's my podcast is the Mailbox Money Show.
I love it. I love it. Bronson, you mentioned earlier Robert Kiyosaki's Rich Dad, Poor Dad. That is probably the single like financial, planning, financial investment book that I get recommended most often, that most of my guests mention. Are there any other books that you have read that you really like that you recommend?
Yeah, so I like that. That book's a great book. His second book is called Cashflow Quadrant, and he talks. It's kind of how do you move from an employee or from self-employed to become a business owner or an investor, and that's how you reduce your taxes and make more money. That's a great book. Gosh, I think this year I've read 77 books, and there's a lot of great books out there. There's a really good book on negotiating called Never Split the Difference by Chris Voss, who's a former FBI negotiator. I'm not sure if you've read that book, but I see you shaking your head there. But great book. Just basically says everything's a negotiation. You're talking with your spouse. You're walking across the street. Everything's a negotiation. And so if you can just more effectively learn how to negotiate, it will really help you and the people around you.
Excellent. And Bronson, tell us a little bit more. Where can people find more information about you and Bronson Equity, and what's the best way to reach out to you?
Yeah, so the best way is just go to bronsonequity.com, and like I have that free guide, how to use inflation to your advantage. You can check that out. You can also join our investor club, hear about our upcoming deals. We're doing stuff in the multifamily space. We have our ATM machine fund, which is a high cash flow type of investment, and we do some things in alternative energy as well. So we're doing all those things, and also I'm on social media. So if anyone wants to reach out, I'd love to connect with any investors or anybody's looking to scale their real estate.
Very cool. If you don't mind me asking, what kind of alternative energy investments are you making?
Yeah, so there's a lot in the oil and gas space. There's a lot of tax incentives over there as well. So I've personally invested as a passive investor in some oil and gas drilling, but there are other things that are creative around there that basically just allow for supportive technologies such as pulling CO2, carbon dioxide out of natural gas, because that's usually present, and then finding a way to source that. So there are different methods around oil and gas that just are heavily incentivized by the government to try to help increase energy supply in the U.S.
Very cool. All right, Bronson, thank you very much for joining us this evening. It was been an absolute pleasure to speak to you. And if anyone would like to learn more, just reach out to Bronson and check out Bronson Equity. Check out the 2 PDFs available through his website. And yeah, Bronson, any final parting words?
Well, Gabe, I really appreciate you having me. I just encourage everybody that the best investment you can make is really in your own education. So it's through reading books, through things like this. And there's a saying, you'll be the same 5 years from now, except for the books you read and the people that you meet. So that's the networking and the education. And my life has changed. My net worth has gone up 20x by just following that principle. So go to meetups, go to conferences, read books, do it all, and listen to great shows like this one with Gabe. So thanks for having me, Gabe.
I like it. Thanks very much, Bronson. Have a good night.
Thanks.
Thanks. Bye.